We continue with our discussion on balance sheets in Unit 4 of FRA. And in this particular section, we're going to talk about what we look at in terms of the non-current assets or the long-term assets. Right, so we have already seen the short-term or current assets. Now we are looking at the long-term assets, also known as non-current assets, and any assets that are going to have a life of usually greater than 1 year or greater than one business cycle. So the technical definition is 1 year, but you could sometimes extend it to one business cycle. Usually it is 1 year or more, right? The reason these are called as non-current assets is that they're going to generate benefits over their lifetime, right? So they're going to generate benefits for the company over their lifetime, and hence they're kind of termed as assets and long-term assets. They will create money or create cash at some point, at some point, right? At some point in the future, all these assets would basically create cash, and hence they are termed as assets broadly, right? Let's look at the example that we were looking at. Once again, Tata Steel. And in Tata Steel, we have these non-current assets first. So this entire set of headers is under non-current assets. The first part of non-current assets that you see is fixed assets. Right now, this is an important context in terms of understanding what fixed assets are. Fixed assets are any of the assets that are going to generate the main operating income for you, right? So these are the fixed assets or the long-term assets that the company has. Now, fixed could be divided into two parts broadly. There's tangible and there is intangible. We know that tangible assets are those which are physical assets, which can be seen, touched, felt. So your factory, plant, machinery, equipment, everything will fall under tangible assets. Intangible assets are assets which cannot be seen, which cannot be felt. It is just that the presence of these assets gives you some sort of an advantage. So things like a license, right? All these telecom companies operate, they have a 10-year license usually. You have radio companies which run FM radio, they have licenses, right? You have patents, which pharma companies have. You have copyrights, which media companies have, or you could have, authors have. And then there is one another asset which is called as goodwill. So we'll come to goodwill separately, but broadly those are the tangible and intangible assets. Tangible assets are the ones which can be touched, which can be seen. Intangible are the ones which are not seen, right? Then we see two more terms here, which is capital work in progress and intangible assets under development. Remember that the balance sheet is as on a date, right? Which is typically, let's say, 31st March of the year. Now, if you start building a factory, so you start building a factory, let's go back, start building a factory and not complete it by 31st March. It's a factory, you have put in 1,000 crore in it, but it is not yet operational. So it has to be classified under long-term or non-current assets. It has to be classified under, so it has to be classified here, it has to be classified here, but it is not yet a tangible asset. It is not yet ready, right? So if there is some factory, some equipment, some plant that is under construction, has not started generating money for you, that is what is called as capital work in progress. Now remember, this work in progress is different from the work in progress we've seen earlier for inventory, and hence we put this prefix capital, which basically says that this is fixed assets which are being developed at this point of time, tangible fixed assets which are being developed at this point of time but have not completely been developed, right? Then similarly, you could have an intangible asset that is under development. So you could have a software, for example, that you're making, but you have not completed it. You have not completed it by 31st of March. Those would get classified as intangible assets under development. Correct? Now, the way you look at these assets is basically if you have a tangible asset under development, once the asset development completes, capital work in progress will come under tangible assets, right? So let's understand this. Once the work is complete, all that you see here will go and fix here. All that you see in intangible assets under development will go and sit here in intangible assets. So if a company is not doing any capex, you will only see the first 2 points. If a company is doing some sort of capital expenditure, they're expanding capacity, they're doing work around adding more capacity, that's going to come here in these two headers, right? So this is what you are currently developing, but you have not yet finished developing. Those are all my fixed assets. Then we move to the next term, which is called as goodwill on consolidation, right? So there are two interesting points here. The first part is goodwill, the second part is consolidation. Now, in layman terms, goodwill is nothing but brand value, right? So the next question that will come to us is, how do you value brands? Every company will believe their brand is valued high. So how do you arrive at this number, whatever this 13,000 crore kind of a number is? How do you arrive at this number? There must be some mathematics around it. So in reality, under accounting principles, such subjectivity is not allowed. The only way goodwill can come on a company's balance sheet is if it has in the past acquired another firm, right? You have to go and acquire another firm to have the possibility of seeing goodwill. How does it come? Let's say there is a firm A and there is a firm B. Firm A has cash of 1000 and firm B has total assets of 500. Now A buys B. At the end of this, A and B get together. So the fixed assets that come in come worth 500. Now let's say A buys B for 1000. Right? So that's what we say. They can buy B for any price they want. So they end up paying 1000. So the assets that come in is 500, but the cash that goes out is minus 1000, right? They've given out 1000 crore of cash and they're only getting assets worth 500. That doesn't make sense, right? One, why should you pay more for the 500 crore worth of assets? Two, the balance sheet will not balance after this transaction. So the reason we believe that they must have paid more for this transaction is we believe company B must have some brand value or goodwill. So we add that adjusting figure in the term of goodwill. So at the end of it, the balance sheet will see fixed assets of 500, goodwill of 500, and a cash negative number of 1000. 1000 cash goes out, 500 fixed assets come in, and whatever is the difference, that amount of goodwill will come in. So goodwill will only come if there is an acquisition by this firm done for another firm, and hence it will only come under consolidation. So when you consolidate these, you see a goodwill of 13,000 crore, which means Tata Steel paid 13,407 crore extra while buying something, while buying some company. And if you dig a little bit in terms of news, they bought a company called Chorus in UK and Europe. They're now planning to sell it because they couldn't really run it properly. So they paid extra, and whatever you pay extra is going to come here as goodwill. Now this has more important implications, which we will probably talk about at a later stage. But at this point of time, what is important is to understand that goodwill is an intangible asset, and it is nothing but, essentially a sort of a balancing figure in acquisitions. So you have paid extra, but how do you balance that in your balance sheet? You do that by putting this number of goodwill. So in real sense, this is not exactly brand value. This is just the extra payment you have done for a particular asset while making an acquisition. That's what is called as a goodwill, right? Let's move ahead and look at some of the other ones. We see non-current investments, we see deferred tax assets, we see long-term loans and advances, and we see other non-current assets. Let's take them one by one. Non-current investments, in contrast to current investments, which were effectively kind of cash equivalents, non-current investments are those investments which are made typically for strategic reasons. Right? So strategic investments are this. So what is typically going to happen is such investments will not be sold. Right? Take an example. Let's take the case of Tata Steel itself, and I'll use a hypothetical example. Steel companies need iron ore as input. So it's quite possible Tata Steel went and bought a stake of 20% in an iron ore mine, right? Now, this is a strategic investment. They might have bought shares which are easily liquidable and they can probably liquidate them. But in reality, this is not treated as cash equivalent because you will never sold it, never sell it, right? These will never be sold. And these will not be sold because they are buying this stake in the iron ore mines so that they can get continuous supply of iron ore for their operations, right? So effectively, they are buying a stake in their vendor. If you're buying a stake in your vendor, it is typically for long-term reasons, and so logically you will not sell it immediately. That's what non-current investments would look like. Typically, you will find most of these are strategic investments in other companies, and obviously this is small investments of 10, 15, 20%. If it was more than 50%, it would anyway have been consolidated. The assets would have come here, right? Then we look at something called as deferred tax assets, right? These are assets which basically come because you have already paid tax on something and you are going to probably enjoy the benefit next year, right? So again, something that is more complicated to be learned at a later point of time, but this is coming, deferred tax asset is coming because you have overpaid tax today, right? One of the ways deferred tax asset could come in is let's say you go and acquire a loss-making company. If you go and acquire a company that makes a loss of minus 100 crore, when you combine this minus 100 crore to your profits, you will save 30 crore in tax, correct? Because your profits fall by 100 crore. So this 30 crore is saved in tax. Now let's say you already paid this tax and then you decided about the acquisition. That will create a sort of a deferred tax asset, correct? You've paid it, you're going to recover this money next year, right? So essentially that's a deferred tax asset. Then we look at the two other terms. Let's move ahead, talk about long-term loans and advances and other non-current assets. If you have given a long-term deposit, let's say, right? It could be a rental deposit. Let's say you are a shipping company, right? Which is using a port and you've paid deposits for 5 years, right? This is a long-term deposit. It's in a way a long-term advance that you have extended to someone. You could give long-term advances sometimes to your customers as well. If your receivables are greater than 1 year, they will come and fit under this long-term loans and advances, right? If there is clarity that receivables are going to come only after 1 year, then that will probably get classified as long-term loans and advances, correct? So those are long-term loans and advances. And then you have what are called as other non-current assets. So anything else that does not fall in this bracket is going to be other non-current assets that come here, uh, which could typically have examples that vary essentially. You know, all loans and advances have already been covered. So any assets that are realizable after a year, other than what we have discussed, are going to be other non-current assets, right? So those are the kind of assets. We're looking at tangible assets. They are long-term assets with physical substance that are used in the company's activities. These are non-current assets are carried at the historical cost less any accumulated depreciation, right? So if you buy something for 10 lakhs and every year the depreciation is 1 lakh, first year you will see the value as 9, second year accumulated depreciation will become 2, third year accumulated depreciation will become 3, and so on and so forth. So they are carried at this value, historical cost minus any depreciation, accumulated, total value lost till now. Then you have vendor invoice cost. What does historical cost? Historical cost basically puts in everything that has come into picture in order to purchase this asset. Vendor cost, invoice cost, freight cost, any additional charges to make the asset operable. Examples would include land, buildings, equipment, machinery, furniture, copper mines, oil and gas property, any resources owned by the firm, etc. All of these are examples of tangible non-current assets. Intangible are amounts paid by the company to acquire certain rights that are not going to be visible or represented by the possession of physical assets. You can have identifiable or unidentifiable intangible assets. Identifiable intangible assets can be acquired singly and typically linked to specific rights which are having finite benefit periods. Patents and trademarks are going to be intangible, identifiable intangible assets. Unidentifiable intangible cannot be acquired singly and typically possesses an indefinite period. That's called accounting goodwill. Some part of this we will understand at a later point of time, which says that goodwill technically is not allowed to be amortized. If I go, remember, depreciation and amortization give a tax benefit, correct? Because this is subtracted from my pre-tax income to get to the pre-tax income. Now, let's say I go and overpay 10,000 crore for a firm and then try and amortize this goodwill. I will get a tax benefit. The income tax department will come and tell me that, look, this is not allowed. If you go and overpay for something, that's not my headache. So I will not allow you to deduct tax on goodwill, right? So technically, goodwill is not amortized. Goodwill is tested for what is called as impairment. Basically, every year you have to check whether this goodwill is intact, which means if there was an asset worth 500 for which you paid 1000, every year you have to check if you sell this asset, will it sell for 1000? That's the question you have to answer. If the answer is yes, then you carry it at 1000. If the answer is no, then you write off whatever you think will not come in. So if you think it will only come for 800, you will have to write off 200 in the form of extraordinary or exceptional items. If you remember, extraordinary or exceptional expenses from the P&L. You've lost that money, right? Don't worry about it if this is not very clear, because this will be covered separately at a later point. Don't worry about it for now, right? So those are unidentifiable intangible assets. And we have non-current investments. Usually these are for strategic acquisitions, deferred tax assets because we have made an early payment of tax, long-term loans and advances, any money given by the company to someone else for a long term. It could be long-term lease, it could be a long-term rental deposit, it could be a loan extended to a director of the company, and any other assets realizable after a year come under the category of other non-current assets, right? Those are broadly the different kinds of assets that are available. That's what brings us to an end to the non-current assets portion. As we end, a couple of questions. What is an intangible asset? Give an example of an intangible asset, and also give an example of a non-current investment. Thank you.